Hey everyone, welcome back to Corporate Decoder, the place where we unlock the secrets hidden within financial filings. But do not worry, we will not drown in jargon today, because even though this report looks all official and a bit dry, it actually tells a pretty interesting story about how a specific fund performed and where its money went. So today on the chopping block, we have an annual shareholder report for the KBI Global Investors Aquarius Fund, which is part of the advisor's Inner Circle Fund III. Think of it like a checkup for your investments, detailing everything from how much it costs to invest and how it performed to exactly what it was invested in. We are going to pull out the most important bits and tell you what they really mean for investors. Alright, let's start with the bottom line for your wallet. How much did it cost to have your money in this fund over the last year? They lay it out pretty clearly based on a hypothetical $10,000 investment. For the KBI Global Investors Aquarius Fund institutional shares, the total cost for the year was $104. That breaks down to a neat and tidy 1% of your investment. Now 1% might not sound like much, but over time those small fees can really eat into your returns, so it is always good to know what you are paying for. Now for the juicy part, the performance. The report tells us that the 12-month period started strong for stock markets up through the third quarter of 2024. However, things got a bit bumpier after that. We saw some shifts in what investors favoured. Big tech stocks that were doing great started to lose steam as economic outlooks softened, and people started expecting the Federal Reserve to lower interest rates. You know how sometimes certain sectors that did well can become market detractors? Well, that happened here. But on the flip side, interest rate sensitive areas like utilities and real estate investment trusts or REITs did better. The big news was a surprise rate cut by the Fed, which initially boosted riskier assets, but then the yield on 10-year government bonds rebounded, affecting performance late in the quarter. The end of 2024 was all about the US election and how that might impact policy. Growth and mega cap stocks really pulled ahead, leaving others behind. For the water strategy though, which is what this fund focuses on, it continued to benefit from support across political parties and ongoing infrastructure spending. The beginning of 2025 was strong, but then equity markets faced pressure in the first quarter due to political uncertainty and worries about global growth tied to tariff issues. This led to more volatility and a shift towards more defensive sectors, which was good for the water strategy. Energy utilities and consumer staples were the top performers, while technology and communication services lagged. After a sharp sell-off due to new tariffs, there were some adjustments mainly on imports from China. This eased recession fears and led to a rally driven by more cyclical stocks. Technology and communication services again outperformed while energy and healthcare lagged. July saw continued strength in technology and energy driven by news about US policy tariffs and spending on things like AI and data centers. Meanwhile, consumer staples and healthcare faced challenges due to weaker consumer demand. Overall, the period saw positive performance for the fund with a net return of 7.01%. However, this underperformed the MSCI Aqua Index, which tracks global stocks, and returned 15.87%. So while the fund made money, it did not keep pace with the broader global market. The report also mentions that the fund did better over 5 years but underperformed since its very beginning. The strategy here is focused on high-quality investments with a defensive tilt, expecting to do well in uncertain times. They prioritize companies with strong pricing power, inelastic demand, and good supply chain management. Let us look at the actual numbers on this performance chart for a hypothetical $100,000 investment. It shows the KBI Global Investors Aquarius Fund ending up with $202,184 since its inception on October 12, 2018. That sounds good, right? However, the benchmark index, the MSCI Aqua Index, actually grew to $210,751 over the same period. So again, while the fund grew your initial investment, it did not grow it as much as the index did. For example, by July 2021, the fund was performing very well, outpacing the index, but by July 2022, it had dropped behind and it stayed behind. Looking at the average annual returns from the 31st of July 2025, the fund returned 7.01% over 1 year. For 5 years, it was 12.6%, and since inception, it was 10.9% annualized. The MSCI Aqua Index, however, returned 15.87% over 1 year, 12.79% over 5 years, and 11.58% since inception. So still trailing the index over all periods shown. Now here are some key stats from the 31st of July 2025. The fund had total net assets of $54,746,376. It held 49 different investments. The total advisory fees paid were $254,861. And the portfolio turnover rate, which shows how often holdings were bought and sold, was 52%. A 52% turnover means they basically replaced more than half of the fund's investments over the year. That level of trading can sometimes indicate an active strategy, but it also means higher transaction costs. Where did the fund invest geographically? Well, the United States made up almost half of the portfolio at 54%. The United Kingdom was next at 12.9%, then Japan at 6.7% and France at 5.8%. Netherlands came in at 5.3%. The rest were smaller allocations to countries like Brazil, South Korea, Switzerland, Canada, Germany, and China, and a tiny bit in other countries. And what were the top 10 individual companies it invested in? Veolia Environment was the biggest holding at 5.8%. Then came Xylem at 5.4%, Kurita Water Industries at 4.3%, and IDEX at 4.2%. SJW Group was next at 3.7%, followed by Pennon Group and United Utilities Group, both at 3.3%. Koei and American Waterworks were at 3.1% each, and Veralto rounded out the top 10 at 2.8%. It is quite clear this fund is heavily focused on the water industry and related infrastructure. Interestingly, the report states there were no material changes during the reporting period. This suggests a pretty stable strategy and portfolio construction. Also, no changes in or disagreements with their accountants. This implies a consistent relationship with their auditors. Speaking of accountants, the fees paid to Cohen & Company Limited for auditing services were $24,700 for the fiscal year ending the 31st of July 2025, and the same amount for the prior year. The report also notes that there were no audit-related tax or other fees paid to these accountants, which is pretty clean. Moving on to the core financial statements, the schedule of investments shows the detailed breakdown. For example, under Common Stock Austria, had an investment in Andritz valued at $768,007. Under Brazil, two utilities, CIA de Saneamento Básico do Estado de São Paulo Sabesp ADR, and CIA de Saneamento de Minas Gerais Capasa MG, were held with a combined value of $1,462,396. This level of detail is usually for the very serious investor, but it does confirm the fund is indeed investing in companies related to water and utilities globally. Looking at the statement of assets and liabilities as of the 31st of July 2025, total assets were $55,304,095. Total liabilities were much lower at $557,719. This resulted in net assets of $54,746,376. On a per share basis for institutional shares, the net asset value was $11.82. The statement of operations shows the fund's income and expenses for the year. Dividend income was $1,256,992, and interest income was $52,322. After deducting foreign taxes, they had total investment income of $1,235,932. Total expenses before waivers was $771,241. However, the investment advisor waived $216,225 in fees. This brought net expenses down to $555,016. The net investment income was $680,916. The statements of changes in net assets show the ebb and flow. For the year ended the 31st of July 2025, the fund had a net increase in net assets from operations of $3,407,882. However, due to distributions or payouts to shareholders totaling $9,191,780, its total net assets actually decreased by $5,113,996. This shows that while the fund generated profits from its investments, a significant portion was returned to investors. Now for the financial highlights presented per share. For institutional shares, the net asset value at the beginning of the year was $13.17. After accounting for income operations and distributions, the net asset value at the end of the year was $11.82. The total return for the year was 7.01%. This aligns with the earlier performance figures. The expense ratio excluding waivers was 1.39%, which is a bit higher than the 1% cost mentioned earlier, but that 1% includes the fee waivers from the advisor. The notes to the financial statements provide more context. The fund is organized as part of the advisor's Inner Circle Fund, the third, a Delaware statutory trust. It is registered as an open-end management investment company. The KBI Global Investors Aquarius Fund is one of 47 funds under this trust. Its investment objective is long-term total return through capital appreciation and income. Importantly, the report clarifies that the fund is non-diversified, meaning it can invest in a relatively small number of issuers. This is a key risk factor because if just a few companies perform poorly, it can have a bigger impact on the fund's overall performance. As for security valuation, the report explains their process using a fair value hierarchy which prioritizes inputs to valuation techniques. Level 1 being quoted prices in active markets, Level 2 observable inputs, and Level 3 unobservable inputs. Most of their common stocks are valued using Level 1 or Level 2 inputs, indicating they are generally holding publicly traded securities. There is a section on federal income taxes stating the fund intends to qualify as a regulated investment company, and therefore no federal income tax provisions are made. The report also shares the tax character of dividends and distributions paid out, which is important for investors to understand their own tax liabilities. For example, the long-term capital gain distributions made up a significant 80.3% of the total distributions for the year. The notes also detail a variety of risks including equity market risk small and medium capitalization companies risk sector, emphasis risk and specifically water-related resource sector risk. This latter one is crucial since the fund is so focused on water investments. It highlights how this sector can be affected by climate, environmental, and political events, which could impact water consumption and conservation. There is also mention of geographic focus risk and non-diversified risk, emphasizing the concentrated nature of the fund. S investments. The foreign investment and emerging markets risk is also noted given its international holdings. A very interesting point is the concentration of shareholders, where 86% of the institutional class shares were held by just 2 record shareholders. These were essentially omnibus accounts holding multiple individual investors. This concentration could potentially influence redemption patterns and liquidity. Finally, the report of independent auditors from Cohen and Company Limited gives their opinion. They state that, in their opinion, the financial statements present fairly in all material respects the financial position and results of operations of the fund. They also mention they have served as the fund's auditor since 2024. The notice to shareholders provides tax information. For the fiscal year ended the 31st of July 2025 long-term capital gain, distributions were 80.3% of the total distributions. Ordinary income distributions were 19.7%. This indicates a significant portion of the fund. S-gains came from appreciating assets rather than just ongoing income. There are also details on qualifying dividends and interest income which can affect an investor's tax situation. Overall, the KBI Global Investors Aquarius Fund delivered positive returns over the past year, but it did lag behind its benchmark index, which is a crucial point. It is heavily invested in the water sector with a significant allocation to the United States and other developed international markets. The fund operates with a clear strategy, but its non-diversified nature makes it susceptible to specific sector and company risks. The advisory fees are managed with a waiver to keep costs competitive at 1% annually. Investors should consider the sector concentration and the fact that the fund has not kept pace with the broader global market of late. While it generated gains, a substantial portion was distributed back to shareholders, suggesting a potential focus on income generation or capital return alongside growth. For those looking for pure broad market exposure, this might not be the first choice given its underperformance against the ACWI index. But for investors specifically targeting the water sector and comfortable with its concentrated approach, it offers a focused investment avenue. What do you think of these results? Let us know in the comments below. If you found this deep dive into the fund, performance and holdings helpful, please hit that like button and subscribe for more. And do not forget to join our Discord community linked in the description for ongoing discussions. Thanks for watching, and we will see you on the next episode of Corporate Decoder.